All right, let me say hello and welcome to each and every one of you. Doug here with the LincolnList.com, and today I would like to introduce to you what I think is the very best swing trading and investment trading strategy for all of you new traders out there, you aspiring traders, and even the traders out there that's been at this for a little while and you're still struggling with consistency and trying to put this whole thing together. I think what you find I talk about today is very easy to understand and comprehend on how and why something like this works. It's very easy to implement into your trading business, and I am absolutely for sure that what I talk about today will make your life a whole hell of a lot easier and a lot more profitable. Now, before I get started, if you do like this channel, show your support by subscribing and also click the icon next to the subscription button. That way you're alerted with each one of my new training videos that are coming out here real soon. So let's go ahead and get started, and let's talk about this pattern. So today I'm going to talk to you about something I call the check mark pattern. Now, I know many of you that follow me here for quite some time already know what this is because it's one of my favorite day trading strategies. I also did a webinar on this not too long ago. But it's also something that's highly effective for swing trading and investing. Like we talked about before, it's easy to understand, it's easy to implement. But the reason that it works so well is because it focuses on the important element of price entry. It puts you, the trader and investor, at almost the best possible price chart-wise that you can be in. And this translates to you having the best available risk versus reward on a stock. So I'll show you what I'm talking about here. Now, many traders and investors, when they first start out, they think stocks just move in one direction. They either think they go straight up or they go straight down. You soon realize that's not true. Even in the most significant of uptrends, there's bumps along the way. So normally what a stock will do, even when it's moving up, there will always be some back testing. There will always be some corrective nature to that stock. So you'll see them move up, pull back a little bit. When I say the word pullback, this is what I'm referring to as a sell-off, a light volume sell-off, not a crash, but a light volume pullback. And then you'll experience another up leg or another trajectory of upward momentum in the stock before it reaches a significant area of resistance and encounters another pullback. And then it again does another wave. I refer to these as waves. You may hear many traders out there on the internets referring to this as like the A, B, C kind of pattern or something like that. And this goes back to as well trader lingo, if some of you are learning that for the first time. The trend is your friend. And what we're really trying to do here is capture the maximum amount of the trend. I may also refer this as alpha. That's what we're trying to do. And that is how you really make money at this sport. So if you think of what a check mark actually is, you know, going back to grade school, a check mark is just one of these things here. Let me kind of get a better drawing tool. This is a check mark, right? Standard old check mark. So you can already see visually where there might be check marks inside of a chart like this. So normally what we're talking about, or what I am actually talking about, is after a stock has made an initial run-up and it has experienced a piece of momentum, rather than us chasing into that momentum, which is highly dangerous, and that's where traders get FOMO, fear of missing out. They get poor entry price, which leads to them being stopped out. And if they are wrong on the trade, they tend to lose a significant amount of money. See, we're not going to be right every time. So what we want to do when I say put ourselves in the best position on the chart is give us that risk to reward. So the times that we're wrong, we're not losing a whole lot of money. But the times that we're right, we're really going to make a lot of money. And as you see, we're looking for pullbacks. They find some stationary, I'll often refer to this as consolidation, some consolidated area, some support area before they rest and then begin that upward trajectory. So let's take a minute and I'll show you some actual charts, what this looks like in a real-time trading environment. So let's go ahead and take a look at the daily chart here on Apple AAPL. And if you're new to this, what we refer to these bars you're looking at is candlesticks, and it's on the daily chart. So this represents each day, 1 day worth of trading activity. So even something that's this bullish and this strong, a stock here that was recently trading roughly at $220 to $227 a few months ago sits now here at $355 as I'm doing this. So you can see even a stock that is this trendy and moving in one direction, there are these corrective pullbacks or these little bumps in the road along the way. You had some selling that occurred right here, and you had some selling that occurred right here, and then just a few days ago we experienced yet again another pullback. And it's important to understand these because these are healthy to a trend of a stock, because each trend, the authenticity of that trend needs to be tested. Again, we call this back testing, and there needs to be some selling pressure to test the authenticity of that trend, whether it's legitimate or not. And you can see along the way that it's done that. So if we quickly just visualize that check mark pattern, you see you have the pullback here, and then it begins the next wave, the pullback here. Sorry that the chart's getting so messy, up here. And then again, we're now looking at something that could quite possibly be the third check mark in this sequence right here. And that's what you're looking for. Now let's first talk about here how you know when you should enter something like this. Since you're familiar with what the check mark pattern looks like, we now want to focus on, well, when do you enter it? And how do you know that the cycle of selling has stopped? Well, in truth, none of us really know, but we do have some sort of ideas, and I'll show you. As traders and investors, we want to look at reference points, and those are also referred to as support and resistance. This is where stocks are most likely to be bought and where stocks are most likely to be sold. Give me 1 second, I'll clean up this chart so I don't mess up our visual. So what I did is just kind of expanded it here into this first little area. And if you're wanting to know what these lines on here, I'm using some moving averages. This is a 10-day moving average, a 20-day moving average, and a 200-day moving average. This is not a moving average speech today, but that's what they are. I'm not going to delete them here. But we're going to talk about just basic support and resistance. So do your best to ignore what these lines are. They do help, but that's not what this is about. So when this thing starts to pull back, this is what the chart actually looks like at one time. It looked like this, okay? Now, when you see this several days of selling here, we look for areas of support. That's where a stock may find an area of buyers. And the further that we move back into our charting, the further that we go back in time, the more significant and the more important these levels become. So as this thing, and how you find support, is you take a look at the bottoms or areas where the stock consolidated and where it held up. So if you take a look at these days right here, in this area, you have just right below this, in this space, let's say it's 263 bucks. And the thing I always want everybody to understand if you're learning technical analysis for the first time, don't make the mistake of thinking everything has to tap it to the penny, that it has to be absolutely perfect. Consider it like a road map, that you're just sort of putting yourself in a certain area, and that's all you're doing here. So you're figuring that somewhere in this zone, this stock should find support. There should be some buyers here because a week ago, a couple of weeks ago, prior to this certain event right here, there was support. The stock was supported. It found buyers there and then made an up leg. So it should continue to find buyers and support down there. And that's where you're looking to enter, is somewhere down in those 265s to 266s. And as you can see, that's where Apple ends up pretty much at the low of that day. Now, if this does not work, let's kind of move into phase 2 of this. If this does not work, you would have to look at the next support, which would be all the way down here at $247, okay? So one of the reasons we use this check mark is because it allows us to be at a good area on the chart. Because we can see that if we get into this at significant support, most likely we are going to get a bounce. If we don't get a bounce, there should be some sort of stalling in price. And when I say stalling in price, I'm meaning the stock should at least slow its selling down there, and you should be able to judge by just looking at the market activity whether it's going to hold or not. But if it doesn't hold support, there's probably above a 70 to 80% chance that it will have to trade back down into this level of the 250s before you're really able to find stable buyers again. So this is letting you know that if that support doesn't hold, then it's probably going to trade down to the next one. This saves you the trader time. You can either cut it and try to come back and enter it, or you enter with a partial position, which is maybe a quarter size, a half size of what you normally would enter, and then you add when you get down there. Now, in this case, the following day, this shows its stability by bouncing off of that, which was somewhat predictable. Now, at this point, the trade becomes crystal clear to you, the trader and investor, because now your risk has completely been defined. And that is your stop and your risk is now at this $263 level or somewhere in that range. So you have now entered at 264, maybe 265, and you have only risked $1 to maybe $2 of your money on this trade for the potential of catching this next upward trend. So hopefully you guys can start to see the balance of risk versus the reward. This way, when you do it, you will know if you're wrong, because again, if it doesn't hold support here, chances are it's going to go way lower, and you'll just have to come back and try to recheck mark that down. Now in this case, as you saw before on the chart, it actually did start to trend upwards. Remember, it doesn't go just straight up, it starts bouncing around, but eventually it does the same thing again, and it reaches this resistance point and starts to sell off. Now the same case here, when we kind of just look at this level, it found support at an area where there was support in the recent past, in this area right here. And this gives you, again, the risk versus reward. So to answer the question, where's your entry? You look for little significant areas of support. For those of you know what it is, you know what I'm talking about. For those of you who are new to trading and you don't quite understand, consider it areas where the stock has bounced, where you see periods of time where the stock has not traded under a certain level. Like right in here, it is not traded under this level. It's not traded under this level right here or this level right here. And that's how you find it. And you want to get as close to that as you possibly can. Remember, you can't just do that perfectly. But in each one of these cases, by doing that, you've captured almost the entire piece of each one of these trends. Now, let me try to answer this question for each and every one of you, because you might be thinking about it. You might say, well, if I'm an investor and I bought it up here, it doesn't matter anyway because the stock ended up higher. And in essence, you're right. You're right. It did in this case. But one thing that people don't always look at when it comes to investing and trading is what happens if you're wrong? You know, what happens if you're wrong, and also your trading is based on not just one trade in one scenario and one circumstances. It's based on a whole body of work. Like if you were to do this 10 or 12 times, what would those statistical results be? How many times would you win on that? And the thing is, we always want to get good entries, because here's the thing. If you were to, let's go back and we talk about that support level. And let's say we've determined that just for this demonstration only here, we've determined that that's that 265, 266 area here on the chart. If you buy this at $288 and you've determined that significant support is $266, we're basically talking about 20 bucks here, right? 20 bucks. And what that means is if you buy it right here, this thing could pull back $20 and the chart is still bullish, meaning the chart is still holding its upward trend. You could still be right on this trade, but you're down $20. So if you put 100 shares on her, that's 2,000. You're in the negative. And this is where it starts to work as a psychological disadvantage to a trader. You might be starting to doubt whether or not this is going to work. That drawdown may bother you, but if you are wrong, that's how much it cost you. It was $2,000. If you did 1,000 shares, it would cost you 20 grand. That's a pretty expensive mistake. By buying down here, the risk was only 1. So do you see the difference? It's not always whether you're right or you're wrong on the trade, because sometimes you're going to get lucky and you're going to confuse luck over skill. In this case, it's showing you, rather than you giving up $20 to make whatever you don't, I mean, now you have to, for good risk to reward, you have to make like $40 on this trade per share since you're giving up 20. Rather than giving up 20, isn't it easier just to give up 1? I mean, think about it. Isn't it easier just to give up 1? And this is how this all starts in the first place. By getting the right entry, it puts you in a good position, number one, not to be stopped out, not to be freaked out, because now you have definitive areas. But more importantly, when you're wrong, you're not losing $20 a share, you're losing 1 or 2. And that's what this sport is all about. It's getting that right, proper risk versus reward. So when you're looking at them, just a brief recap here, you're looking at something that's going up in a trend. So rather than just randomly buying into this, because when you're randomly buying into this, you never know when that's going to stop. You never know when that momentum is going to stop. It could just turn on you the next day. It's what we call chasing. You're just not at the right spot. And again, maybe you get away with this in a bullish market. Maybe you get away with this 3 or 4 times on trades. But over the course of a long, sustainable investing career, or you're investing your own money for the long term, this is going to be a bad idea. This is going to backfire on you. This is why you see professional traders and long-term consistent traders, they don't buy breakouts. And they don't buy breakouts for this very same reason. It's because most of the time they don't work. That's when pros start selling, is when stocks broke out. They want them when they pull back, set up, and then start to re-gear. So anyway, guys, I hope that made a lot of sense to you. As always, just remember, this whole trading thing is a journey. Take your time, be patient with your learning, continue to study, continue to grow, and you'll be all right. As always, if you need my help, feel free to reach out to me at thelincolnlist.com. Until the next video, take care.